Coming up on this week's Redcast.
The problem is when you look at MiFID II, it's all too easy to put sweeping statements because it covers everything, right? It's got every asset class, every instrument that is admitted to a trading venue, which is huge. It is the biggest piece of regulation ever to come in existence in this world. The EU and the UK are looking at exactly the same questions in terms of the reviews that come out, but I think the answers will be different. They might not be dramatically different, but there will be differences and different approaches to it. Also possibly because they might be looking at two different angles.
It's not a revolution as such. It's not a post-Brexit, let's change everything, let's move away from the EU, because as we all recognize, the UK was very instrumental in a lot of what MiFID I and MiFID II looked like, where the US is potentially becoming more global in its stance again, and how that fits together, and whether we get more international cooperation over time, or whether actually we are entering an era where people are kind of closing in a little bit more.
For me, the key is not to create regulatory friction between, the EU, the US, the UK, Japan, whoever, right? Between all these regimes, even where we have some local rules for local reasons or some slight differences or lack of harmonization, if ultimately it's client choice that drives the decision making and people making the best decisions for their firm, then we'll be in a better place than if we create a overly complicated, diverse, global system with friction, which causes people to have to do certain things in certain scenarios. I mean, that's got to be the right outcome for the end investor. And certainly in derivatives, it's always been a global market. And the more complexity we add in, the worse the data quality, the worse the compliance with whatever rule it is, because the more complexity there is.
It's about getting the regulators to understand we need to get to that level of detail to reduce the friction. And in order to do that, we have to take away some of the complexity and tie it back to the things that really matter to the end investor. The biggest theme is there's a huge collaborative opportunity here, and I really look forward to figuring it out with you over the next couple of years.
Welcome to Redcast,
where we shine a light on banking digitization.
Hi, welcome to Redcast. This is DJ Marino, CEO and founder of JDBG. This is where we shine a light on digitalization in the markets and what's happening with regulation. And we haven't yet done one on the markets. And I'm really excited to have this great panel here to help us take us back in time. And for me, this goes way back to the early noughties. I was leaving Barclays on my way to another job, and I went to a trade association meeting on MiFID I. And I saw this huge opportunity to start a great conversation with the industry that's continuing on today. So our first joint working group was for MiFID, and we ran one for MiFID II. So we're well versed in a lot of the topics that we'll be talking about today. I think we've had hundreds of meetings on these topics, but we're in a whole new place right now. We're on the cusp of another seismic shift in the trading landscape. The UK drafted a lot of MiFID. It was the one that really put a lot out there on the table under the Barnier regime. A lot of it was expanded significantly for MiFID II. And now Europe's having a rethink and wondering about which way it's going to go with trading regulations. At the same time, the US is considering what it would like to do with its new administration. And the UK is on consultation with this wholesale market review. So our focus today is really what is this consultation all about, and what kind of changes could it present to the market, specifically in terms of the trading and venues that takes place in our marketplaces, the post-trade space and how transparency and market data might be affected, and of course, reporting, which is all near and dear to many of our hearts. So without further ado, I'd just like to ask our speakers to introduce themselves. Matt, Coop, why don't you kick off first, as we've been at these tables together for many a year.
Thanks, PJ. So my name's Matthew Coop. I'm responsible for global cross-asset market structure at Barclays. Also engage in a number of trade associations. So I co-chair FIX Trading Community for EMEA, which is holds a lot of engagement around data standards and how we engage in terms of the workflow across the transactional workflow. Then also engage in AFME, ISDA, ICMA, and UK finance as well. So sort of engage in a lot of those debates.
And I'm sure Kirsten's with you at a number of those tables. Kirsten, why don't you introduce yourself next?
Hi, PJ. So Kirsten Winters, I'm a managing director at IHS Market. I head risk, regulatory and market strategy for MarketServe, which is the OTC derivatives processing service used by the industry. And as you say, we've been involved in this debate pretty much since the crisis in terms of helping the industry respond to all the regulations that have come down in relation to trading, clearing, reporting, etc. So, very happy to be here and joining in on this latest change or potential change to those rules and frameworks.
Thank you, Gavin. You've had a longer run time with MiFID than even I have had. So why don't you fill people in on that story?
Hi, yeah. I joined Grant Thornton in 2016, and I essentially do commentary on regulation broadly and regulators, why they do what they do, how effective or ineffective they are, and why some of what lies behind that. Before joining GT, I'd worked for the regulator for 27 years, so 9 years at the Bank of England, 15 at the FSA, and 3 at the Financial Conduct Authority, where I was Chief Risk Officer for a couple of those.
So let's get started. I guess I'd like to kick off with some of the biggest changes discussed for the UK's trading infrastructure by this new consultation, which of course we'll put in the show notes as a link. Matthew, what does the consultation paper have to say about getting high resolution democratized markets? What are some really big key themes we've been talking about all year? What do you think this is going to mean for us?
Look, I think this essentially is the UK's consultation on MiFID III. As you said, PJ, there's been a number of iterations, and I think since Brexit, this is a chance to look at how they want to direct and look at the secondary markets and how things are evolving. There's a large number of areas which are covered here. We've got a lot of conversations around market structure in terms of in the equities market space and in the fixed income space. You've got the great buzzwords in there in terms of share trading obligation, double volume cap, multilateral trading, which are debates which we've been talking about for a very, very long time. Then, on top of that as well, you mentioned the democratization and data and how that comes in. I think that is also front and center in one of the key areas. There's a lot covering here around equities transparency and how things should operate, the delivery of a equities consolidated tape, how should that be structured, what data should be going into that. And then also that feeds into the market structure questions in terms of what data and information should be fed from that in terms of the structure of venues and also OTC trading and how that evolves. You've also got the same discussion in fixed income, which I think is actually probably there's a lot of effort and a lot of energy in the industry being spent here. I know Kirsten and I are spending a huge amount of time on calls on this, but around looking at OTC derivatives. Should we have a consolidated tape for OTC derivatives, for interest rate swaps and CDS index? Is there a need for it? How's that going to be delivered? And then also finally, a bond consolidated tape. I think we've seen a large demand across the sell side and the buy side for the delivery of a bond consolidated tape. But then the critical questions when you're looking at that is how do we then structure this to make sure we balance the provision of risk so that ensure that we have effective transparency, but also we have effective markets operating so there's not over transparency out there leading to over volatility and price reversion in terms of when risk is being provided. So I mean, in essence, it's we've got a huge number of topics. I mean, further on top of that, I think it would be remiss to notice the fact that there's also been further consultations out over this week as well from the Bank of England and also from the FCA when looking at the clearing obligation and the derivative trading obligation. We're looking at LIBOR replacement, and this all feeds into the sort of the MiFID debate mixed into that. And then the critical part that goes alongside that is, as you said, we've got exactly the same debate happening in the EU. So how's this going to shape out? Where are we going to get from that as well?
Yeah, and I'd be interested in your perspective, I guess, from a market structure point of view. A lot of the debate around MiFID II was about liquidity provision and making sure people actually they were getting effective market structures in Europe. Where are we on liquidity? Or is it, is there a problem to fix?
We need to break this down. I think that the problem is when you look at MiFID II, it's all too easy to put sweeping statements because it covers everything, right? It's got every asset class, every instrument that is admitted to a trading venue, which is huge. It is the biggest piece of regulation ever to come into existence in this world. So when looking at that liquidity question, is there, let's look at equities. Is there a problem around liquidity provision there? I personally don't think there is. I think we've gone through quite a lot of systematic turmoil, macro from the COVID crisis have happened, and I think markets have functioned, and they have operated well. And so I don't think there's been a liquidity problem there. When we look at fixed income marketplace, I think markets have functioned. There have been challenges. There are challenges when you look at the provision of risk and the restrictions that banks have on the balance sheet that they can put out there, because let's face it, the majority of fixed income trading is delivered off risk. So that is a critical discussion point. And there are also global discussions happening here as well. Let's look at the US Treasury market, some of the biggest biggest marketplace for bonds. And they did have a bit of a liquidity crunch last year. And so there is a lot of focus from the SEC coming from that. So, that's a key area that's going through. The other point is when you look at liquidity, you look at liquidity migration as well. So if you look at the other point in terms of market structure, derivative trading obligation and Brexit, we now have a sort of theoretical wall between EU and UK in terms of the transaction of interest rate swaps and firms not being able to transact on an EU venue or being able to transact on an EU venue and not being able to transact on a UK venue, and then liquidity moving to CEF. Does that really impact liquidity? I don't think it impacts liquidity because people can just execute and flow can still carry on. It just makes added complexity. And then the other element, I think, which is an interesting discussion, is the discussion around transparency. And the view has been put out there from some policymakers, not necessarily from the UK, but does transparency beget liquidity? Because I've got transparency out there, is that going to increase liquidity? And I think there's an interesting debate there to be had where, I don't think it necessarily does. It might assist in terms of other participants coming into the market. But then the critical point that you need to look at there is what is the effect of that? And what happens when you have over-transparency? Do we then have a fragmentation in terms of sizes, trade sizes breaking down, and then having increased intraday volatility around that? So there's a real in-depth discussion being had, but you need to break it down beyond the high-level labels that I've kind of put there. We need to look into IG credit. We need to look into high-yield credit. We need to look at sovereign bonds. We need to break it beyond sovereign bonds. We need to look at EM versus G20, and even G5 versus G20, because not each instrument fits the same liquidity profile, and it does evolve from that.
Yeah, that's a really great point. And I think one of the challenges we all have is the data, right? Is it high enough quality to really work out what's going on? Kirsten, I'd like to come to you because you had some really fundamental research that helped people understand early on post-Brexit what's been happening with these flows. What's your perspective with a fixed income hat on here? Is there a transparency liquidity link, and is there a problem there we have to solve?
Yeah, so I think MiFID in and of itself, when it came in regards to derivatives, I think it recognized the roles of SIs. SIs and derivatives are different to SIs and equity. That's important to know. Equities are not fixed income, are not derivatives, and therefore the rules and the frameworks are different and the behaviors are different. So when you put that in place, what happened to market structure with MiFID was there was a trading obligation, so more activities on venue, but the SIs obviously play a crucial role around that, providing liquidity. And generally, the introduction of OTFs, generally that's worked. And it was only really when Brexit came along and we had the lack of equivalence between the EU and the UK, where we saw, clearly some Euro activity move to EU venues because it had to, but actually more activity went to the US CEFs. And this is because there is obviously equivalence between the UK and the US, and there is between the EU and the US, but there isn't between the UK and the EU, albeit they have virtually identical rules today. And what that did was cause two things. One, a bit of a market share shift, but the second and probably most important one is it caused loss of access to markets for certain firms. So if you're a UK firm with no EU sub, you cannot access EU venues. And conversely, and probably to a greater extent, if you're an EU firm without a UK sub, you cannot access UK venues. And so what that caused, as Matt said, is a geographical fragmentation. Certain firms cannot access certain markets. There is still liquidity there, people can still trade. There is still activity and hedging occurring, but there is not free access for all firms in all markets. And that is just a fact and is shown up in the data.
Yeah, no, that's a great point. This is a global equation. Gavin, I'd like to pull you in here because the global question is really interesting from a UK strategy point of view right now. And for years, for 12 years, the UK hasn't had to worry about much of this. It's been just following Europe. Now it has an opportunity to think about what the play really is. What do you see as a UK market without the guardrails looking like?
Right. So it's a difficult one because some of this is kind of is an element of kind of reading the tea leaves. But first of all, I think particularly in the last 5 years or so, I think the UK withdrew a bit from that kind of international set of fora. From about 2015 on, it became, I think, more domestically focused. And you see that with some of the structural stuff where there was no longer an independent separate markets division within the FCA, and it got subsumed within a much larger strategy and policy directorate, I guess. And I think regaining the influence that we had won't necessarily be easy. I don't think it's like flicking a switch. So there's that. I think Matt talked about MiFID III. I think for me, it's a bit more MiFID 2.5 in the sense that a lot of what's out there at the moment are probably, are ideas that have been floating around for a while, as everyone said. And to some extent, they're things that, from memory, that the UK would have wanted to have MiFID II reflect. But obviously in the nature of kind of compromises across a 28-state EU process, you don't get all of what you want. So there's a little bit of that, I think.
So you're saying it's back to the future?
I think that, there's an element of that. There's an element of kind of, these are things that we would have wanted to do before. So now we can do them. And I think you see that in a sense that, the way in which, the consultation can come through really quite quickly. And they're relatively, they're significant in themselves, but it's not a revolution as such. It's not a post-Brexit, let's change everything, let's move away from the EU, because as we all recognize, the UK was very instrumental in a lot of what MiFID I and MiFID II looked like. So there's no enormous stepping away onto a different set of tram rails here. It's much more of an iterative, a sort of an iterative approach to the whole thing. And I think the other thing is the kind of, what's the timeline for some of this? What are the implementation dates? We all know how long MiFID II took to actually come into effect. And it'll be interesting to see what that sort of, what sort of horizon we're looking at for some of these changes actually happening.
Interesting. So we can see a future then where we might agree the same thing is the policy objective, but we get there well in advance of when Europe actually delivers.
Yeah, and I think we've talked about the international element of this, and I think and how what's happened in the last few years is to an extent put sort of boundaries between jurisdictions that weren't there, and I think it will be interesting internationally to see what sort of impetus there is to kind of re-engage those different jurisdictions so it becomes easier to do business globally without some of the added complexity that Matt was talking about. And I think we've also talked quite a lot about breaking down instruments and being more granular in effect. Whereas part of what the UK is doing, I think, is trying to step back and say, this isn't for regulators to sort out. This is for the industry to kind of set the ground rules. And how effective that is in practice, we'll have to wait and see when you're talking about, training internationally and so on, because you do have a push and pull between, let's have principles, let's have more granularity, and what's the respective cost involved. And that's a debate that's going to carry on for the foreseeable future.
Yeah, and speaking of costs, I mean, this whole PFOF, payment for order flow discussion, in the rise of the meme stocks, and the crowd that needs access to the markets is a new theme, really, but in some ways it's part of what was baked into MiFID I. One of the keys there is getting data cheaply. Having the little guy be able to access the same information about the market, and that's been a real big sticking point. Matthew, can we start with your view about what's been happening with the data and how we get a more effective oversight of the commercials around it?
Yeah, I mean, I think it's quite simple. And I think we kind of need to break this out as well in terms of when you're looking at data. I think there is a big challenge of data costs internationally within the industry. I think there are significant challenges in the EU. And some challenges in the UK. And I think what we need to do when we're looking at data is, when you're looking at market structure change in general, let's take a step back, is the critical thing that you need to go back to your point, PJ, is what are we trying to do for the end investor? Even when this is wholesale markets, the critical thing is you've got asset managers, you've got insurers, you've got firms representing retail clients. And so the critical thing is when we're looking to change something, what's the right result we should get here for the end investor? And so let's start with that question to try and look at answering the data problem. So from my perspective, I think you've got an issue where essentially market data is used as a very strong commercial tool within a number of organizations, and particularly probably trading venues. And this is not just an equities issue. I think this covers fixed income, and it's going to be a growing issue in fixed income as well, where you're seeing a greater trend to leverage more data, more analytics, more TCA. You then become more data hungry, and I think so. There's a growing demand appetite because trading feeds off data, right? So it's important to have that. So what's the data coming from? The data is coming from market participants, whether it be retail, wholesale, whoever, engaging in a venue or off venue and creating a trade and then passing it through a pipe to someone to be able to disseminate. Now, if you look at the market data revenues, these are growing significantly, and you look at it from the stock exchanges, which are publicly listed, also from other companies as well. And so people commercialize this data. So what does this mean? If we have over commercialization, and I'm not in any shape or form saying that if you're providing a service, you should not be able to make a profit from it, but it's about the reasonability of it and making sure everyone has engagement and access to it. But if you're charging a lot of money for data, you're putting barriers to entry into the market. And that's not a good thing. because particularly when this data is feeding about price transparency to the end investors to be able to understand what is going on in their asset class. And particularly when all it is a distribution pipe. You're putting the pipe out there, you're chucking the data out. So should you be able to have and get high margin profits from it? I don't think that's the case. And I think we should be having greater scrutiny on that, because I don't think it's protecting the end investor or enabling better efficient markets. So to your comment at the beginning, PJ, we should have democratization of data. So how do we get there? Potentially it's the delivery of a consolidated tape. And I think the other critical point to that is looking at the two different areas that you have with data. One is the on-venue transactions, and then the other one is the OTC transactions. Now, MiFID II brought into the landscape the delivery of more effective OTC data across all asset classes. I'd argue that it was too broad, too much, too fast, too soon, and there was not enough sorting out of the actual detail behind it. But it brought it. And so if you can aggregate that data effectively and deliver it on an effective commercial model so that everyone can have access to it, you're going to have a better, more efficient marketplace. And that, to me, is the cornerstone of what a CTP should be. Now, to get there, what we also need to do is work on the data standards. We have to work on how we identify transactions and to make sure we're proving a common approach. And from my perspective, I spend a lot of time in my fixed co-chair role, because fixed is the language that everyone submits these trades in terms of trying to work through that. But there's some really big fundamental questions out there. If you look at a bond, how do you price a bond? Now, it's not as simple as an equity. It's a lot more complicated. You can price it a number of different ways depending on the bond. And that wasn't really defined in the regulation. And I think, again, it's a classic area where Gavin was saying, is the industry, we need to be grown up individuals to actually set these standards and work through how that product lies and actually put those data standards in place. So then we have much better data. So in summary, if we've got two areas, one, we sort out the commercialization to make sure that we can have effective delivery of market data. And two, get much better data standards, we're going to have a better marketplace. The critical then debate is then going in to make sure, how do we balance that to make sure that data is accurate, appropriate, and we're not putting too little data out there or too much data out there, and it impacts risk provision in the market.
Kirsten, I'd be fascinated to get your perspective there. We've talked about the consolidated tape now for years, and it was sort of left to the market to sort it out, and it didn't really get sorted out. You sit in one of those seats where you obviously you've seen many sides of this argument. Will a CTP solve the transparency issues that Matt was just talking about?
No, so I think PJ, in and of itself, no. I mean, consolidating the different sources of transparency together, making it easier to consume, clearly is an important step, and the CTP therefore is valuable in that context. However, to Matt's point, if you don't solve the data standards issue, if a commercial model that enables it to happen, then it will never happen. It will never happen, or it will happen, but the data will not be as good or as usable or even usable at all. But it's important again to separate equities versus fixed income versus derivatives, right? Clearly in equities, there's investor demand for a tape. In fixed income, there's also, quite a lot, it seems like there's quite a bit of demand there for a tape. In derivatives, really, seems little demand from end investors for a tape. That said, if you're going to go ahead and have a tape for derivatives, the first thing you need to do is fix the current transparency regime. It's no good bringing together the current data and putting it on a tape if you're not going to fix the underlying transparency regime. And fundamentally, two identical trades cleared at two different CCPs have a different price, but they look identical on the tape. A 10-year swap looks the same as a 5-year forward starting swap. So fundamental problems with the data, because ultimately, the current transparency regime is not complete, not fit for purpose. So if we're going to implement a tape, we need to make sure that those standards are set, the right fields are in there, and therefore you've got the basis for the right data. But then you need to create an environment, as you alluded to, with regards to the commercial model that incentivizes, someone to be able to provide a tape, and either that's mandatory submission or other options. But clearly, to date, despite the initial consultation being 6-7 years ago, no private sector firms come forward and built and offered a tape, and there's good reasons for that. So there's two parts. One is standards, resolving the current transparency problems with the transparency regime, and the second is creating an environment where a tape could be successful. And then, a tape would be of value, certainly in equities, to a certain extent in bonds. Derivatives, I think there's still a question.
So let me ask you even a harder question then, given that later today we're on a derivatives digital regulatory reporting call. We've learned an awful lot about standards, in the past 5 years. I think there's actually one of the benefits of RegTech and SupTech is that we've kind of focused on how do you tie very complex rules to a common domain model, and how do you think about then specifying what good looks like? Are we in a better place now? I mean, we have better chances of success if we implemented the DRR techniques that we've been playing with for the past 5 years?
Yes, I think we are, and I think people have been reporting data post-crisis for 10 years. I think the key is purpose, though, and when you're defining something like requirements for transparency, it's important that you're defining the fields you want with that purpose in mind. Clearly, if you write a set of rules for a regulator focused on systemic risk, you're going to want different fields to a regulator focused on market abuse or transparency data, right? So it's important to look at what is the purpose, what fields do we need, and then what format we're going to get them in is the easy bit at the end, really.
I'm glad to hear you say that's the easy bit. Gavin, a lot of times we've been constrained as an industry because we get these very prescriptive spreadsheets dumped on us at level 2. Or even level 1 in the text within the European context. Will the new UK regime give us more discretion, or give the industry the ability to come together and help propose more sensible formats and standards?
I mean, my sense is that's clearly part of the aim. I think how it works in practice, we will have to wait and see, because I think it's, on one level, it's been part of the aim for quite a while. We've talked about this, for a few years, and you're right, it's come on. But if we went back 3 or 4 years, we probably thought it would have moved faster than it has. So I think they'll definitely want to do that. I think that, again, coming back to where I was before, I think there's probably less expertise in the regulators than there was a few years ago, and I think having the institutional confidence to step back, as much as you're implying, I think is probably a bit of a leap. I think there's probably political pressure to kind of step back and intervene less as well. I think that's clearly where post-Brexit the government is coming from. But I'm not yet clear how well thought through all of that is. So there is a bit of wait and see, I'm afraid.
I noticed you just put out a thought piece on the latest FCA business plan, which was delivered later than usual, in part because there's a lot of new people coming into the FCA. What's your sense in reading that business plan about the extent to which the FCA can become a center of excellence that tracks the gray hairs required to be able to pull some of these standards off?
I think it's hard at the moment to be too confident about that. I think there's a few kind of basic things. One is there's not obviously any more money being collected from fees. Matt and Kirsten are probably really pleased about that. But there's quite a lot of commitments, extra commitments being made across the board, particularly on the kind of retail consumer side. and they've got a huge sort of data strategy in FCA terms, certainly 120 million over 3 years. As far as I can see, that's being essentially paid for out of savings that haven't been designated in any way. So there's a lot on the kind of transparency program they're going through, which again, we know a limited amount about. So there's all that basic financial stuff. I think there's also, you may have seen, there's something in the annual report about effectively encouraging managers and technical specialists who've been in place for a long period of time to take redundancy, early retirement, move away. That might all be great, but there are downside risks to it in terms of loss of corporate memory and expertise and so on. I do remember, a coterie of people who were very happy sitting in the same role for multiple years because they loved the work and they were actually quite good at it. And they, many of them could have earned considerably more in the private sector, but actually they liked doing the policy. I don't know if the FCA is losing significant numbers of those people, but if it is, they will be a loss. So the grey hairs you're talking about, it's hard at the moment to be too confident about that.
Okay, interesting. Matthew, I'm sure some headhunter will be knocking on your door soon to see if you want to work for the regulator. But imagine you stay where you are. How do you see best practices and the role of standards in all this UK debate? And where would you like to see it all go in the next couple of years?
Look, I said, I think the first question you start at when you're looking at this is, and when I try to assess anything, is what do we think is the right result here for the end investor? How do we deliver a more effective marketplace? And also the other bit to go that is to ensure that the market is stable. And I think those are the two questions which will always be core. I'd like to think it would be core to any employee at the FCA or any regulator. And I think that's the critical part. There is an element though in terms of as well is actually just trying to cut the bureaucracy. I think with MiFID II, as you know, PJ, there's a huge amount of stuff there which doesn't really make sense. It doesn't deliver any benefit. You've got the classic examples of costs and charges. You've got what you'd call in inverted commas the best execution reports of RTS 27 and 28, which don't really fit the bill. They don't deliver any benefit. Although some elements of best execution has dramatically improved, and that's come from the much higher level term of you must be more quantitative and qualitative in terms of your approach to best ex, which I think has actually spurred a more international response as well across asset managers, which I think is really positive. So it's not to say that we need to be pulling straight back and going into full principles-based regulation, but it's cutting the stuff that just doesn't make sense and potentially was there as a political compromise because someone else was pushing another agenda. And that's where I think the other part of this as well as the debate is the FCA, in terms from the UK angle, they are a well-established entity. They've got some great people within their organization who have excellent experience of financial markets. And so they're going to be pragmatic. And I think it's enabling them to be able to make the right judgment, I think is really, really important. And then the other part to that is sort of looking at some of the business mindsets that come through. And I don't think we're going to necessarily have a direct cut and paste in terms of, or a policy change. It's going to be exactly the same as what we're having from the EU. I think the EU and the UK are looking at exactly the same questions in terms of the reviews that come out, but I think the answers will be different. They might not be dramatically different, but there will be differences and different approaches to it. And also possibly because they might be looking at two different angles. The EU has a very strong push around CMU, Capital Markets Union, looking at the retail investor. And the UK has a very strong and a very long history around wholesale markets. And so there might be a stronger focus on that thing. So which might end up with differing sort of outcomes in terms of how the regulations approach. Although I think the intent and the objectives potentially may be still the same.
That brings us nicely back to Kirsten. I'd like to get a bit of a impact assessment from you then on what this means for harmonizing digital rule books. Long been talked about, long an objective to be able to take the 1.8 million paragraphs of MiFID when it went live, plus then the 2,223 documents have been published since it went live, and try to make sense of that against a bunch of new UK texts. Forget about the US, we'd have to do a lot more manipulation for that, but it's all getting possible, and I guess that's part of what we've been talking about here around the standard space for years. What will this ever happen? Will we be able to digitize these rule books?
Yeah, so I think there's two parts to it. One is the harmonization, globally between jurisdictions, and one is then once you've got to as harmonized as you can, and clearly that won't be fully harmonized. How do people consume that? How do people keep up to date with what's changing and implement that in the most cost efficient, and more importantly, if it's efficient, ultimately it would be more accurate. So I think the harmonization piece, I think, CP Moscow did a lot of work with the industry for dating back, for 6 years now. Clearly things have worked, right? LEI, nothing's perfect, but LEI is working well. It's widely adopted. All the regulators are harmonizing into that gradually over time. Things like UTI standards have been created. A whole list of 80 odd data elements have been harmonized to a certain extent. And things like UPI, in my role with Anna DSP on the product committee there, we're currently looking to implement that. So, clearly there are areas where a lot of work has been done and standards are being created. There is clearly a whole host of other data fields where, they're just going to be different. They're not going to harmonize. And technology needs to be able to handle that, right? Equally, there's going to be policy objectives like the MiFID debate we've just been having, where the UK will make changes, the EU will make changes. Some of those will be identical because actually they make sense for both sides of the channel. Other areas, UK will do one thing, the EU will do something else, and that will filter down into what the industry needs to be able to cope with. And I think, clearly, the more people can digitize the consumption of those rules and the ongoing implementation, because it's not a one-off cost, it's a continual cost, a continual evolution, the better. And loads of work's gone on, including what you guys have been doing with the industry. There's still more to do, and clearly the more we can harmonize globally, the better. But it's never going to be, and nor should it be. It's never going to be fully harmonized. So it's taking the wins where you can, making the process as efficient as you can, and then just keeping up to date as it continues to evolve.
Fantastic launching point for my final question. And we just have a minute left. It's amazing how quickly these conversations go. My final question is, if I sum up what I'm hearing from you guys, the issues that we're trying to address are fairly well known, and they're not that different either side of the channel or even across the pond. But we will have different agendas, and there are therefore going to be some different policies that people take. And to glue these together, we need to have better rule books and some standards to support them. Where are we likely to see the most painful points of divergence, and how do we get ahead of those to sort of lessen the pain? I guess in your concluding remarks, help us inspire us to action that will really make a difference. Matthew, let's start with you.
Thanks, PJ. It's a great question. I think, where do we start? I think the interesting thing to start with is to basically look at the EU versus the UK, and let's look at the two different consultation papers. We've got consultation papers out on RTS 1 and 2 from ESMA, and in terms of proposed changes where they're looking at, and the European Commission are also doing a lot of work there. And then we've got consultation paper from HMT. When you look at it, I think there are a number of topics within the marketplace particularly in equities market structure, where you look at double volume cap, STO, you look at various outcomes that come from that, which from a practitioner's perspective and trying to, as I said, answer the question, what's the best interest of the end investor, I don't think it adds up. And I think they should have been got rid of a long time ago. And I think the industry has been advocating on that for a very long time, but unfortunately the message doesn't seem to be coming through. Whereas the UK, I think, has got the message, and changes are afoot. Having said that, there's harmonisation, and both are pushing to initiatives to try and get more effective transparency. Now, whether the scope of transparency and the precise technical ways it's implemented measure up, I don't think that necessarily will happen. We'll have to wait and see. But we're still still geographically, people are going to be utilising data from Europe and also utilising data from the UK. So I think there's areas where actually harmonisation and tying up in terms of data standards and how things can place in and also understanding where you do have those slight differences, you can actually pick out and understand that data. As long as we can work through that, and potentially that's the action item that we as the industry need to work on to be able to leverage that, because we all have international businesses operating. Barclays, we have the biggest bank in Ireland, and then we have obviously Barclays in the UK, and so there's a lot of work that's going on there. So you are going to want to leverage this data into your business models. So if we can maybe work on that one, I think that'd be really useful. So we're not going to see massive divergence here, because I think everyone works to the same outcomes in terms of where we're trying to drive it. It's just slightly different lenses. And nothing's ever going to be the same. There's always going to be a slight different lens, as you said, in terms of where the bias or where you're thinking about your market should go.
Yep. Excellent point. Great summary. Kirsten, over to you. What's your perspective?
So just take a slightly different slant, really. I mean, for me, the key is that client choice should ultimately drive what happens. So, where someone trades, who they trade with, where they clear it, which trade repository they report it to. But for me, the key is not to create regulatory friction between, the EU, the US, the UK, Japan, whoever, right? Between all these regimes, even where we have some local rules for local reasons or some slight differences or lack of harmonization, if ultimately it's client choice that drives the decision making and people making the best decisions for their firm, then we'll be in a better place than if we create a overly complicated, diverse, global system with friction, which causes people to have to do certain things in certain scenarios. I mean, that's got to be the right outcome for the end investor. And certainly in derivatives, it's always been a global market. And, the more complexity we add in, the worse the data quality, the worse the compliance with whatever rule it is, because the more complexity there is. So, I think it's important to remember, who's doing these trades and why they're doing these trades in the first place.
Thank you. Gavin.
So for me, I think there's probably a couple of things. One is, the coincidence of Brexit with, as the combination of sort of moving towards a more kind of UK national approach with the change of administration in the US, where the US is potentially becoming more global in its stance again, and how that fits together, and whether we get more international cooperation over time, or whether actually we are in an era entering an era where people are kind of closing in a little bit more. So there's a kind of a global national tension there. And then I think the other thing is how granular we need to get in order to achieve harmonization and data standards and so on, and what's the balance between that and the sort of the cost involved in getting there. And whether we can, get to a point where actually the same, we can trade with confidence across jurisdictions because we know what we're talking about. We're talking the same language the whole time.
Fantastic summary, gentlemen. I would summarize all that based on the reversing the order of play. It's about getting the regulators to understand we need to get to that level of detail to reduce the friction And in order to do that, we have to take away some of the complexity and tie it back to the things that really matter to the end investor. And so I've taken a lot away from this conversation, but the biggest theme is there's a huge collaborative opportunity here, and I really look forward to figuring it out with you over the next couple of years. So thank you all very, very much. Thank you to our audience for hanging in there for what will be the dog days of August. You can always subscribe to Regcast. Please do. It's on all the platforms. And if you have any suggestions for what you would like us to be talking about, let us know. Or just add some comments to the recording platforms and help people find us. So thanks all very much. I will end the recording now and see you soon.
You can download the podcast via Spotify, Apple, and Google. But also, I'd encourage people to come to the JWG website, which, as hopefully you will know, is jwg-it.eu. Go to the Intelligence Hub and create your bespoke library. This is Regcast,
where we shine a light on banking digitization.